Hey everybody, what's up? Time for an update. Stock market, big correction going on. Stock market, Dow Jones down over 500 points today. And I believe this is the 5th day of a down move in the market. Now, for those of you who are MMT Trader subscribers, my report, you know that last week, October 4th, I sent out an email to all subscribers saying that they should expect a big time, and that was the phrase I used, a big time correction in the stock market. And I based that on the level of bullish sentiment, which was very, very high, and we needed to shake some of that out. So that is happening. I called that top exactly perfect. If you want to see that email, to see that I'm not just saying that, go to my website, pitbulleconomics.com, and sign up for a 30-day free trial of MMT Trader, or you could sign up for a 30-day free trial of Zombie Trading, my Forex signal service, or sign up for a 30-day free trial of both. And I will be happy to send you that email and also send you today I sent out a lot of emails with all kinds of updates, very, very interesting updates, many of them pertaining to what is happening right now in the stock market and what the outlook and what you should expect. Very important. Is this the beginning of a major downturn? Is this just a correction? Should you be buying here? Should you be selling here? You got to know these things. All right, that's point number one. Point number two, I sent out probably 2 weeks ago that oil was at a top, and I have been reiterating that even going back to last week when WTI traded up to a new high at 76 and change. And I had subscribers saying, Mike, you said oil was going down and it popped up. Should we turn around? I said, no, just stay calm, stay short. It is going down. And now we see today that call was absolutely correct. Now, tonight we get the API inventories, where I suspect we're going to see some bearish numbers. Tomorrow we get the EIA Weekly Petroleum Status Report. That's normally released on a Wednesday like today, but because of Columbus Day holiday, it'll be released tomorrow, which on that report I expect to see bearish numbers as well. You know what's been happening, and I've been talking about this in my report. Maybe I even made a couple of videos on this, is the fact that product inventories now have completely erased their deficit, the deficit that has been there for, in some cases, over a year. That year-over-year deficit in products, gasoline, distillates, that's been erased. Not only is the supply back to normal, but in some cases, like gasoline, it's actually very high over last year. Probably, I think it was about 8% higher than last year. Significant surplus. In addition, we saw refiner inputs, which is the refiner demand for crude, drop very, very sharply. We saw imports going up. So all this stuff is not bullish for oil. And we found out last week that the Saudis and the Russians made a deal back in September that they were going to increase output starting this month, going into November. So all these things coming together. Now, what happened last week, I think, is that a lot of people jumped into the market ahead of this Hurricane Michael, bad hurricane. A lot of people jumped in there expecting a spike in oil. No spike happened. It's selling off now. And if you get these bearish inventory and demand numbers, which I think we're going to see in the reports, you're going to have a nice correction. But what does that mean? Get my report, MMT Trader. I tell you what to do. I tell you what to invest in. Go to my website, pitbulleconomics.com, and sign up for a 30-day free trial of MMT Trader. I will send you the email. I've been talking about oil today and what the outlook is looking like right now and what to expect and how to position yourself, you know, for the next few months at least, if not longer term. Dollar is down a little bit today, although it's still within those ranges that we have seen since June. So nothing really has changed. I mean, since June, We have seen the dollar trade below 95, above 95. I'm talking about the dollar index. And that remains the case. Of course, you all know about my call in the interest rates where I said bond yields would rise above 3%. We had so many people here and out there on the internet, and even big time Wall Street banks saying 3% was the top in rates. I said it's going to keep on going. It is a function of the monopolist, and the monopolist is the central bank, meaning it's the Fed, and they're saying we're going to push rates up. So it goes up. If John D. Rockefeller of Standard Oil back in the day said he wanted to price oil at X, oil was going to be at X. His little competitors couldn't do anything about it. He would crush them. All right? It's not about the bond market vigilantes. It's not about demand for bonds. It's not about inflation. It's not about recession or anything having to do with the economy. I'm telling you this, we could be in a deep recession, and if the Fed wanted rates at 10%, they could put rates at 10%. Now, what else is going on? You got to read my emails today because they're really, a lot of information went out. A lot of information went out. Oh yeah, the other thing I wanted to talk about, which I find very interesting and very fascinating and very, I have to be honest with you, very amusing, is the fact that, for example, yesterday, what's his name? Robert Kaplan, head of the Dallas Fed, gave a speech at the Economics Club of New York. By the way, I went to one of those Economics Clubs of New York meeting years ago. I'll tell you about that one time. Fascinating. And I'm saying that kind of, tongue in cheek. But seriously, you gotta hear about that. Anyway, he said, gosh, this flat yield curve, it's saying bad things about the future of the economy. Because he's saying, look, long-term yields are not going up. That the bond market must be predicting, it must be telling us that a few years out, the economy's in trouble. Well, first of all, we don't know. That's a prediction, so nobody can be 100% right on a prediction. But what he fails to understand, it appears, is that the Fed has given guidance as to where it expects rates to be going out a year, 2 years, 5 years, long term. And if you look, that's why we all sit around every month when there's a FOMC meeting and we wait for the dot plot, right? That dot plot is where the FOMC members plot their expectation of where rates should be, and that really is strong guidance for their own monetary policy, right? And if you look at that dot plot, and it's available online, and I sent it out to my subscribers today, the median is right around 3% going way out. So what happens? Bond yields are nothing more than a reflection of Fed policy over the term. In other words, what's Fed policy going to be for 2 years? What's it going to be for 5 years? What's it going to be for 10 years? What's it going to be long term? And the Fed is saying long term, based on that dot plot, we see 3%. So what happens? Everything converges around 3%, and you get that flattish yield curve. So Kaplan doesn't understand that it is the Fed itself, the guidance that it is giving, which is creating the flatness in the yield curve. And by the way, I should mention, I got into this business in 1979, okay? In 1979, the Fed was an opaque institution. It told you nothing. If it raised interest rates, boom, you didn't know if next month it was going to do it again, if next month it was going to cut interest rates, what rates were going to be 3 months down the road. So the bond market at that time had no guidance, really. It had a guess, it had a project, and you had, whenever it started raising rates, you had a steepening, all right? But ever since, I would say going back to Bernanke, I think it was the Bernanke Fed, the Fed has changed explicitly. They came out, I remember it was Bernanke who came out and said, we're going to be very communicative, very open, all right? Very transparent in our policy, and we're going to tell the market, we're going to let them know. So ever since they started doing that, what happened? You saw the yield curve get flatter and flatter and flatter. Why is that? Because they project out. They tell you now, going way out, we see 3%. That's basically their policy. So everything converges to 3%. If they said going out, we see 5%, everything would converge to 5%. Still going to get a flat yield curve. If they said we see everything at 1%, everything's going to converge to 1%. So here you have a guy who's the president of the Dallas Fed and also on the FOMC, who's like, gee, I don't know, the bond market, it's telling us something about the economy. It's not. It's reflecting what you guys are saying. That's it. So it's really, I mean, it's amazing when you think about it. Here are these guys, highly educated. They all went to elite schools, Harvard, Princeton, Yale, Wharton, right? And they're running the Fed. And it's not just the Fed, by the way. You could talk about the ECB. You could talk about the Bank of Japan. You could talk about the Bank of Canada. You could talk about the Bank of England. I don't care what bank. They're all the same. And these guys are so out of sync or lacking in understanding of not only the monetary system, but their own role, their own actions. They don't get it. Now, if you get it, as I do, as my followers and my subscribers do, we could take advantage of that. We know how to take advantage of that. The rest of you don't. You're guessing like, oh gosh, the yield curve's flat. We're going in a recession. No, it has lost its predictive power because of the transparency of the institution now of the Fed. Just want to let you know. All right, everybody, go sign up, pitbulleconomics.com. Sign up for a 30-day free trial. I'll send you all those emails. Educate yourself. Educate yourself. Don't sit there like a zombie. Bye.